their interest this afternoon. Thanks, Keith, for the invite here. And I'll make sure that I move along in that relatively orderly fashion. I don't want to get in trouble with the bride. You never want to get in trouble with the bride. So Marquee Energy, we got started about 4 years ago. We're a light oil resource play company. You know, as was mentioned by the previous speaker here, we certainly saw an oversupply issue in terms of natural gas in Canada, and for that reason, we focused on looking for a light oil resource play that we thought we could put together a good position, use technology to create shareholder value. And we believe that we did that in the Machichi area of eastern Alberta, which is just outside the city of Drumheller. The play itself, we were first mover. Through being the first mover in the play, we were able to establish quite an extensive position relatively cheaply. Because there is a lawyer in the room here now, here's our forward-looking statements. Just a quick snapshot in terms of what we have, just over 5,000 BOE a day of production. Our corporate declines right now currently about 22%. If you look at other junior oil and gas companies, you know, certainly we're top quartile in terms of having relatively low declines, which are important in terms of maintaining production, particularly in times of low commodity prices. Our cash flow this year, despite the low price of oil, between $22 and $24 million. The enterprise value right now, looking at where we're trading, certainly above $110 million. And insider ownership of the company, just under 15%. So certainly our insiders have a very strong stake in terms of the success of the company. Our shareholder base is quite strong. I could put all the shareholders around one table that probably represent about 60% of our current shares outstanding. Myself, I've got about 36 years of experience in the oil and gas business now. About half of that would be in the junior space. We have a very experienced board and management team, all of them deep in terms of junior E&P experience. And with that, we think that we put together a good strategy in terms of creating a successful company. And naturally, over the last 36 years, I've seen a lot of commodity cycles. And with that, I think I've gained the experience that you need in order to, both survive these cycles, but thrive once we come out of them. And with experience, I've been in the junior E&P space now for about 18 years. A good portion of that with Mike Kabanuk, who was up with the last presentation from Granite Oil. And as we go through the presentation, you can see that we've checked most of the boxes that we think that you need to check in order to create a successful junior oil and gas company. Just a map showing the location of the property. As I mentioned, just outside the city of Drumheller, about an hour and a half drive. It's all rolling farmland, very friendly landowners, year-round access. We own 100% of the lands in this area. We don't have any environmental issues, no problems with native groups also. The property that we have at Machichi represents about 85% of our current value. We have another small property just outside the city of Lloydminster as well. Despite the fact that, as I mentioned, we don't really have any native issues at Machichi. Machichi is actually the native name for hand. Just some quick geology here for anyone in the room that has any geology leanings. The play that we're chasing in the areas at the top of the Mississippian sequence, and it's a Banff limestone play. The thing that makes this play work itself, though, is we've also identified two other pay zones, one within the Mississippian, one just above it in the Mississippian. So when we drill a horizontal well here, through the Mississippian. We multi-stage frack it, and by doing that, we gain access to 2 other pay zones as well. And once we started targeting spots like that in terms of the land holdings we had, we saw a pretty significant improvement, not only in terms of the overall oil production that we have, but just the consistency in terms of results. As I mentioned, as a light oil play, we see about 10 to 15 million barrels of oil in place per section. This map on the slide shows the extent of our land position in the area. We own about 270 square miles of land. The map sheet itself on that page is about 25 miles high and about 20 miles wide. So we actually took a drive out there earlier this week, and believe me, when you're going down country roads, it takes you a long time to go from the southwest corner of this map up to the northeast corner. So it's really impressive once you get out here. In addition to that, we own most of the infrastructure in the area as well. We've got 3 gas plants, 2 oil batteries, an extensive gas gathering system. With that kind of ownership in the area, we essentially have a stranglehold here. It's very difficult for anyone else to compete in terms of gaining access to other lands that may be available. Once again, we own everything you see here 100%. In terms of well performance lately, we've drilled 35 horizontal wells at Machichi now. Since the beginning of 2014, we've drilled about, I believe it's 19 wells now. 4 of them you don't see on this particular bar chart here, but you can see very, very consistent results over the last year and a bit. Once we figured out what was the best way to get the oil out of the ground here, and also to get the most oil out of the ground here, we've gotten some good results as well. Recent well results, as you can see from the graph on the slide, well above type curve. The wells we're drilling here cost about $2 million to drill, case, complete, and get tied in as well. We're down from about $3 million 2 years ago. So we've seen a good movement in terms of costs here. Part of that related to cost reductions as a result of low commodity prices, but we just are getting better in terms of what we're doing in the area as well. Our IP rates on the wells that we're drilling, about 185 barrels a day of production. This particular graph shows the kind of rates of return that our wells can generate at different oil prices. The green line on the bottom represents our current type curve. So you can see even at $40 oil, we generate a positive rate of return on wells we're drilling. As I mentioned, recent results are getting better. We think the red curve here more accurately represents the kind of wells that we can drill. So for example, at $50 US WTI, which we hit today, we think that we can generate rates of return almost at 70% and generate payouts at about 1.2 years. Just another slide. Everyone in our business now is looking at cost reductions as a way to improve cash flow. The lower your costs, the greater your netbacks. This slide kind of shows you what we've done in terms of both our drilling costs and getting our wells tied in. The quicker you can get your wells tied in, the quicker you can get cash flow. By owning the infrastructure, that's enabled us to get our wells tied on quicker and see cash flow from the money that we spend. Just another slide showing you what we've done in terms of our cost structure over the last 3 years. So you can see very significant improvement in terms of all elements of the cost structure of the company, including our operating costs and G&A, and at the same time you can see the kind of improvement we've shown in terms of actual production per share growth for our shareholders. This slide is a slide that was put together by Peters & Co. recently. Just shows you the kind of payouts for all of the type plays that they look at in North America. And going back here on the left-hand slide, that's the left-hand side of this particular slide. we show you where our Machichi play fits in relative to other plays in North America as well. So we're certainly top decile in terms of payout performance. Earlier I talked about all of the things you got to do to create a successful junior E&P company. Cost structure, we think we've got a strong balance sheet here now, one that is going to enable us to weather the storm, with the low commodity prices. Our wells are showing strong production performance, and as we go through on a well-by-well basis, our wells keep getting better. So we've got strong economics. We own a very large amount of land here, 100%, along with infrastructure. So we believe that we got all the boxes checked in terms of what you need to do to create a successful junior company. Our catalyst coming up, very shortly here, probably in conjunction with our Q3 results. We'll announce the results of our 4-well drilling program we had this summer. We've also launched a water flood pilot in the middle of the area that I showed you on the previous map. Water floods have the ability to double the amount of recoverable reserves from the wells you have, and with that, we see a pretty significant value in terms of the value of the company. We continue to work on our cost structure as well, and we've done a number of deals here over the last 2 years, and we're spending our time now, integrating the assets we've acquired and optimizing the operations on those assets. So in conclusion, we have, I think we've got a strong junior E&P company. We've got strong management and board. We've been there before. We're focused on in terms of creating shareholder value. And as you can see from our analyst coverage page, we've got a very deep set of coverage in terms of companies that cover us in the oil and gas sector. Thanks for your attention today, and we'll talk to you later.